I think that also goes back to the development game where that still's not easy in terms of constructing new apartment communities. And so I think what I was always asking some of the developer buddies that we have, I want to see the first LOI where the land seller is paying the developer, which is kind of how that math would have worked out. And I think we walked through that on a couple of these podcasts early on too. So I don't think that, I get the thought process there. I can imagine whatever brokerage firm you were talking to didn't love that response, even if it is reality.
Saddle up. On today's edition of the Real Estate Anonymous podcast, we are headed to Castle Rock, Colorado. We're about, an hour or 45 minutes south of Denver. We're looking at a build to rent deal. And we get into the ins and outs of why someone might want to own this, and we'll kind of talk through that a bit. We also, perhaps the most important topic we cover is which Mexican restaurant that is closely located to this community has the most attractive pitch and the best green chili. So for that and more, stick around. Good morning. Another beautiful day here in Boston, Massachusetts, joined by Eric Weatherholtz and Brett Moss. I'm Elliot White. And before we got started, Eric seemed to be redecorating his house. He was throwing some pictures around, making a shitload of noise, but you seem good and well. I have a new microphone. If you're feeling slightly aroused by the sounds of my voice, that's because the audio quality has improved dramatically. And Brett, what is up with you, sir?
It's been a lot of planes, trains, and automobiles over the last couple of weeks, but as a very talented real estate broker, I think we are looking at a lot more transactions heading into the second half of this year. I think a lot of sellers are just kind of coming to grips with reality and kind of saying it's been a tough slog over the last couple of years, and we're not going to make as much money as we thought or we were in 2021 or 2022, but it's kind of just back to reality, resetting of expectations for folks out there, which is good for the market. I mean, there's going to be winners and losers like there are in every one of these situations. So if we knew how the answers were going to shake out, what fun would this be? So the show of life continues in the real estate business.
In your space, how often are you dealing with more sophisticated real estate funds and REITs? And how often are you dealing with the syndicator crowd where they kind of over-levered with floating rate debt? Is there a prevalence of that in the kind of Class A world?
I don't think the over-leverage on debt side is discriminating between private capital, syndicators, or institutional at this point. We've had some meetings with some of the very largest apartment owners in the world, or managers of the world. And, again, I pay attention to what people are saying. You can also hear what they're not saying too in a lot of these conversations. Sure. And so if values are down 25 to 30%, just a back of the napkin calculation, like that math equation isn't great, even if you took out a relatively conservative amount of debt at the acquisition of a deal in late 21 or 2022.
Yeah, I think you're going to see a lot more transactions coming up in the next, let's say, 6 to 9 months. I think it's going to start to get pretty busy. So,
and nobody's advertising there's distress out there. You don't want to be that guy, but I think it's coming into view that folks are not.
I want to be that guy.
Yeah, the cash in refi is not going to be great for everybody, and I think we're looking at a few cash in sale closings probably throughout the year. Would you kind of?
Oh my God, I haven't. Eric, you may have seen this, but this is a real thing that I did. I made an offer to the Bricadia guys in Alabama, Mississippi. There's some multifamily brokers in this market. They're selling some truly distressed deals that a lender owns. It's like 800 units. They are totally fucked. The deals are currently losing $6 million a year. And I sent them an offer, and I debated between do I write negative $3 million and highlight it in red and put brackets around it, or do I? And that felt more theatrical. But so what I wrote was seller will pay buyer $3 million for buyer to take 100% fee interest in the property. And they didn't love that. They did not seem to appreciate my offer, which to me, it's like, I know where the train's going. You're going to lose $6 million. You're going to keep stepping on your dick thinking that you can fix this. Oh, the market's not giving us a fair value for this and we can fix it. But you can't. You're just some lender in New York, and you're not going to go run these deals in the middle of nowhere, Mississippi. So you can lose $3 million to me today, or you can lose $6 million over time. I thought that was a pretty fair offer. Needless to say, they didn't share my entrepreneurial spirit.
Well, I think that also goes back to the development game where That still's not easy in terms of constructing new apartment communities. And so I think what I was always asking some of the developer buddies that we have to I want to see the first LOI where the land seller is paying the developer, which is kind of how that math would have worked out. And I think we walked through that on a couple of these podcasts early on too. So I don't think that I get the thought process there. I can imagine whatever brokerage firm you were talking to didn't love that response, even if it is reality.
Well, speaking of negative economic value, let's talk about the build to rent community space. Specifically, we're heading to Castle Rock, Colorado today. Does that sound right, Brett?
Yeah, Castle Rock, Colorado.
We're looking at a deal called Red Hawk Crossings. Eric, do you know this part of town? The
weird parts of Colorado. It's kind of between Colorado Springs and Denver. Scenic part of the world. Very scenic part of the world. There's a lot to like about this area.
I will tell you that
they got.
I'd say 10 for 10 on finding an off the radar, beautiful mountain town and you knowing it. I feel like there's no part of Utah, Wyoming, Colorado, or Idaho that you haven't not only been to, but spent time in. And so the streak continues. One day we'll find a place. You'll say, fuck, I've never heard of this town.
Well, we should maybe just come up with like a make-believe, like Western town. See if Eric's like, I've been there.
Just fake an OM to catch him lying.
Yeah. Just change it all to some phony baloney town that doesn't exist. But he's the secretary now, so he knows everything about everything.
He knows everything.
You got to stay on top of these things.
Yeah. So, Brett, what do we got today?
So we've got 60 build-to-rent units in Castle Rock, Colorado. So this is 2015 vintage, which is kind of a very early mover in the build-to-rent industry, I would say. So I think on the surface here, this looks interesting. I mean, I think a lot of groups are saying, the more stabilized build-for-rent product would be a preference of theirs to where leasing and rents are more proven out, just given that those have been really hard to peg. So just on the surface here and looking at the profile of this deal, I would assume this gets a fair amount of play here. But we'll scroll through a little bit more and see what we like about this and what we don't like about this. So
now, would you say this is truly sort of build to rent in the way that most people are thinking about it today, or are these just townhomes and they thought, well, build to rent's kind of a catchy term? I mean, do you see much of a delineation between townhome product and build to rent? I think that's probably a question some people would have.
Yeah, I think that's a really good question. And so fortunately for the seller here, this property was developed before kind of the true build to rent industry came together in, let's say, late 2010s, kind of heading into 2020s. And so these guys are going to benefit from developing a townhome product before build to rent was a thing, and try to ride the upward trajectory or what feels like endless supply of capital for this type of product today. And the biggest thing, that delineates these communities, are they individually platted, i.e. could you sell them one off to, not another investor, but potentially kind of a resident that would be there, an owner resident. So the exit or the optionality around exit's important for a lot of groups, even though we haven't seen anyone exercise the one-off sales exit here. And again, I think the key part about that is individually platted. Today, most investors are looking to buy build-for-rent communities at some 10 to 15 to 20% discount over what the three of us could go buy the same home for on a for-sale comp basis. So I think that's kind of the biggest delineation, Elliot, to your question there.
All right. That's helpful. Eric, looks like we're in an industrial park. Does that sound right? I mean, if you look at that aerial...
Yeah, let me go back to talking about.
Yeah. You're on the edge of an industrial park. I don't know that land is in super short supply. So, Eric, are you living here because there's not a lot of apartments, or because you're only here short term, you're not buying a house? You got any thoughts on this type of product in this type of market?
I think this is, the key Elliot White question: why would somebody want to live here? And I think that's TBD. I think in general, this is you're kind of in the jet wash of, somewhere between Denver and Colorado Springs, and, a general growing economy, attractive part of the world. But the specific demand drivers for living in this place. Let's dig a little deeper and see.
Yeah. On a map, you're probably, I'm just guessing here, you're probably an hour-ish, hour and 15 south of Denver and probably an hour and a half north of Colorado Springs. I don't believe that anyone living here thinks that this is a commuter town. That doesn't quite sound right to me. And they're talking about home values of $900,000. So presumably people are wanting to live here for a reason.
Yeah, I think that there's also the dynamic here of there's other kind of factors in play here for the matriculation of the U.S. Population in terms of aging. There's not a lot of other options out there for families that are graduating from a 2-bedroom apartment to a 3-bedroom, 2.5 bath, 1,500 plus square foot apartment unit where your kids can go outside on grade, or your dogs or whatever, and you don't have somebody above you and maybe one person to the side of you. So I think that is kind of one of the bigger draws to build to rent from my perspective. Is it's kind of when you have kids, you got to move out of the maybe more sexy, cool locations into some of these more approachable locations. So I would say this location isn't super surprising for me from my perspective.
And it looks like there's stuff nearby. I'm looking at an aerial. You've got, some bars and restaurants kind of that. It's not just an industrial park. There's appears to be some services, but it's still, you're strategically located near a McDonald's, a Waffle House, and the Guadalajara family Mexican restaurant.
Well, I agree with that. No, so that is, again, build for rent location. But what I would say is we haven't seen a whole lot of build for rent communities that are this close to a Whole Foods and a Sprouts. And again, that's kind of my very unscientific gut check in terms of these locations. I mean, the grocers seem to do a better job with demographic trends than about any other person out there, no matter how much demographic research we do. In the real estate.
I remember seeing a rent house, decades ago now, in Glenwood Springs, Colorado, which is kind of the time was the blue collar cousin to Aspen. And there was a house for rent, and I pulled a flyer on it for grins, and it said walking distance to Taco John's.
Nice.
Thinking
that's got to be a great taco.
Marketing amenities that you can rent from me, and in minutes you can be bellied up at Taco John's.
Get your hands on some Taco John's. So with no traffic, I'm looking right now. It's 30 miles and 40 minutes. So I guess you're a little closer to Denver. There's, at rush hour, maybe it is that hour to hour and 15. I guess I shouldn't completely rule out commuting, but that seems thin for people who are living here.
No, well, I'm telling you, Castle Rock it's a nice sort of, it's nice. It's quite Whole Foods and Sprouts in Castle Rock. So that tells you a bit about it. I guess the question is, for these kind of deals, I'm always curious. It's kind of, it's like the Elliott line of Airbnbs being, all the hassle of a hotel without the scale. Build to rent seems to be like, I guess the argument is all the hassle of single family rentals, but with a bit of scale. Is that sort of that kind of the fair way of looking at it? I
would say that's very fair, Eric. And I think Elliott's shared some really good property management stories on a variety of these podcasts. And I do, think folks like Elliott and folks that it's not their first rodeo on an 80s vintage deal, and you pick the location, you kind of understand from an operation perspective, i.e. how the deal is going to lease up, some of the operating expenses, whether it's repairs and maintenance. You know what's coming 8 turns ahead. But in the build for rent space, I think the big X factor on this is how the properties operate 3 years after you buy them, 5 years after you buy them. And that's kind of one of the big things that most everybody's drilling down on at this point, Eric, to your, I think you hit it on the head. It's kind of,
we've got enough history with this one. What is this telling us?
Right. And I think that's what is giving people more conviction around some of these communities where it's just not, hey, I think this is how it's going to work.
Okay. What kind of, so what is their what is their, if Brett, this is your business, looking at somebody comes to you to sell this thing. What are the metrics that you're looking at to decide if it's one you want to take on?
I think this slide here, which for folks listening on the radio or on whether it's at iTunes or Spotify, is this discount to home ownership dynamic is a very, very big dynamic across the spectrum in the U.S. today. And again, I think we've talked about it. Affordability in the housing industry is not going to get any better here in the short term. So I think it is really the positioning here is you can live in a place that's 30 minutes from Denver at a 70% discount to owning a home there. And I think that's the crux of kind of the whole build for rent industry today for folks that are saying, I don't have 20% to put down on a deposit. The home builders are not making as much of a margin to where they're able to kind of buy down interest rates to a more palatable number. So I think that the slide and the whole pitch is kind of discount to owning a home. Probably not too silver from apartment rentals.
Yeah, I agree with you. I think that's right. I'm looking on Zillow, sort of dual tracking while we're talking here. And what they're saying appears to be correct. I mean, the only homes that I see for sale within let's say a 2-mile radius are $1 million, 1.1, 1.2, 1.1. So it's kind of right around that $1 million mark. So I know you're not, you don't own this place, right? If you're in a build to rent, it's not yours. So yes, it should cost less, but that monthly burn seems to be much lower. And they're talking about what appears to be an average rent around $1,950.
Yeah.
Is that right? And so
it seems very approachable.
If you're buying this, do you think that there seems to be a huge spread? I mean, on $1 million home, your monthly burn could be $6,000, $6,500 all in. And your rent here is $1,900. It seems like you've got some room on the rent over time where you're still a discount to home ownership. Are you looking at some type of value add strategy here? Are you thinking about, upgrading any of these units? They seem to be in good shape. Maybe that's a dumb business plan.
No, I don't. I think the buyer here will be somebody that's convinced themselves they can do that, right? I mean, kind of on every one of these value add deals, it's kind of like, or these, and this vintage of product, whether it's conventional multifamily or build for rent today, is kind of where it seems like the lion's share of capital has lined up. And I would define this as a core plus opportunity. So a really well located community and great demographics from a build for rent standpoint, really compelling discount to home ownership or retail sales comp. So I think this would do very, very well in Denver and Colorado Springs. From what we've come to learn, has been ridiculously hard to develop new product there too. So I think there is a big scarcity dynamic playing out in the greater Denver, Colorado Springs, or I guess that's the I-25 corridor, right?
Yeah. Do you know what the vacancy has been here? I mean,
it's been really good.
So if you're telling me it's core plus, I would assume it looked like maybe it was 97% occupied. I thought you clicked through one of those slides. I could be wrong, but
so I think you've got it's a well-performing submarket. Obviously, there's some forward-looking projections here, so who knows if those are true. But yeah, I think this submarket looks like it's performed very well. And it does seem like that Centennial Airport, I've never flown out of it, but a lot of the folks in the real estate game that have done well in Denver seem to fly private planes in and out of that airport a lot, which is always a good sign, I would say.
Yeah. Well, I assume that's how Eric gets around these days.
Yes.
I'm at the Greyhound station. What is what's not to like here, Mr. Moss?
I'm having a hard time picking anything apart here. The unit count, which I know we previewed, what was that, a 32 unit deal early in our tenure on this podcast, which I think we kind of batted around a little bit, but the unit counts on these tend to be a lot smaller. So 60 gives you some pricing power versus leasing up 150 of these. And I think the other thing here that might jump out for anyone that is watching on YouTube is there's no amenities here, which you wouldn't really typically think of, or you think of being a big hindrance to performance and occupancy, but there's not a lot of amenities in these build for rent communities, especially the sub 100 unit ones. And so the biggest amenity, going back to the comment I made earlier, is being on grade, being able to walk right out onto the sidewalk or yard with your kid or dog or whatever. And just a larger overall format for families.
This would not have on-site management though, right?
That's a good question. We'll scroll back to the pro forma. I would think if this thing is 95% full, which is, 50, what is that, 57, 58 of the 60 units, you could manage this kind of in a hub and spoke model, or where you kind of have a roaming management team or maintenance team there. So I don't think you would have an on-site management team there, Eric. That's a good question.
What I would do if I bought this place, I would go back to that picture we were just looking at that showed kind of the front yards right there. I would assume this is a driving community.
Absolutely.
I don't know that it's that walkable. And so the back of the buildings is the garages, and I assume everyone is entering and exiting their home that way. Mm-hmm. They might sporadically walk out a door, but that seems unlikely. So you've got this front yard with this sidewalk going across all of it. I'd try and get a handle on if that was even used, because I think you could add a ton of value to these things if you dug that up and you just put in fenced in yards along the front.
Without a doubt. That is what I would say is, kind of what you want today.
I think I'd rather have a fenced in yard. If you're telling me I have kids and a dog or whatever, you could have, a fence and then a gated fence you could walk out, I guess, if you wanted to. I'd be curious how many people are walking around here, how valuable this front sidewalk is, and if people would rather have a fenced-in yard for kids and dogs to run around in.
How far is Taco John's? Can we look up?
Let's find out.
Is this a walkable community?
Let's see if there's any good taco stands nearby.
Now we're getting down to the really compelling stuff with this.
Oh, good. I've got some exciting news. So it's maybe a half-mile walk. You got to walk across a highway. But you've got Pollo Eats, the Guadalajara family Mexican restaurant, Santiago's Mexican restaurant, and Dos Amigos Mexican Grill. So,
knowing nothing more than those names, what are you?
You're a buyer.
With?
Yeah.
Well, yeah. I'm saying which we're going to lunch right now.
Oh, all right. So I'm going to give you the names again: Pollo Eats, Santiago's Mexican Restaurant, Guadalajara Family Mexican, or Dos Amigos Mexican Grill.
Okay, a few observations. I think when you throw the grill on there, completely discounted. Like, that's not going to work. That's somebody that's LARPing as a true Mexican restaurant.
Right. That's a guy named Dave selling tacos.
Yeah.
Yeah. Agreed.
I'm kind of drawn to the family restaurant.
Yeah. Yeah.
The Guadalajara family restaurant. Yeah.
I agree. Dos Amigos is second. Dos Amigos is on my list.
I have the benefit of also seeing the descriptions of each. So Guadalajara is a colorful spot for traditional plates. Santiago's is hearty fare and signature green chili.
Yeah.
And Dos Amigos Mexican Grill is humble spot for classic Mexican fare.
I think I'm still going Guadalajara.
You're sticking? Okay.
Yeah. Yeah.
All right. I might give the signature green chili. I might give Santiago some play. So yes,
if that is a great feature of Colorado that you're not going to find too many other places.
Yeah.
Green chili that can be a super strong situation.
Or what about the Christmas sauce where you do the red chili and the green chili? That gets really good. Really good. I agree with that. The green chili has piqued my interest.
Finding a good pork green chili in Colorado can improve your lifestyle.
Do you think we could get them to sponsor the podcast?
we should. Okay. We should ping them.
We can eat it during the.
If you're in Red Hawk, please support one of these local businesses.
Right.
Brought to you.
Brought to you by
Mexican restaurant.
So I think it's pretty clear to me why people want to live here in this submarket. It's clear why people would want to live at this property. There's probably a few things you could do around the margins to move rents, maybe $50 or $100 at least renewal. But this doesn't seem to warrant down to the studs remodeling. It was built in 2016. It appears to be in great shape. So then really the question is, you need to factor in some CapEx because we're coming up on a 10-year-old property. So there'll be air handlers, there'll be some roofs, there'll just be a couple things that you should size on the front end. Make sure you have enough reserves set aside for it. And really this is it's a function of yield. Like if you're willing to pay X for a pretty steady coupon, great. If someone's willing to pay a little bit more for a smaller coupon, I think that's probably how this gets bid up. So if all these things are true and you believe in the demand, you like the product, what type of, let's say, levered total return are you looking for on a deal like this? I'll probably throw to Brett first and then Eric. If you're buying this, where are you happy?
I'd say mid-teens on this. So 14 to 16 would be my guess. And again, I think Denver, we've seen some monster trades in Denver, so I could see this getting some significant institutional interest.
Okay.
So
14 to 16. What are you talking about?
Levered IRR.
Okay. What about just a cash return?
Just like a stabilized yield on cost?
Yeah.
6-ish, I'd say, for this location.
So that's always my question with these things is like to have a annual cash return of say 6 seems like you're making some pretty good assumptions about growing those rents over time and a terminal value that would get you to a 15-ish% internal rate of return. But do you think that's where people are, right? You would say what sort of cap rate for something like this if you were brokered?
I would tell you this would, I'd be surprised if this wasn't in the very low 5s. So I think with this huge amount of capital that's been raised around this strategy, which again, I think I'm a big believer that it makes sense long term, but more questions than answers at this point. But this is a location that nobody's going to get fired for buying, right? You're close to a Whole Foods. You can convince yourself you're in Denver here. So this is a location that the vast majority of the market could wrap their head around. And again, not get fired for buying a deal close to a Whole Foods versus a deal in the middle of a field. And you pick the place and
Savannah.
Right there. Well, yes, that's fair.
That one that you drug around. What kind of debt do you think you could get?
I think that's another guy. This would be an all cash buyer. I feel very confident in that, and they'll figure out what to do with the financing on this. But you'd get some folks that would be more leverage dependent too. So I think this is somewhere in the 55 to 60% range with the permanent lender.
So 5, and you think it would sell at a 5.25?
Yeah, I do.
5% to 5.25% cap rate. Wow. Elliot, are you a buyer?
I'm not a buyer, but not because I think that it's bad real estate. This just isn't what we typically buy. I like to buy things that are a little rougher, where we can do a little more work. But I do agree with Brett. I think that's probably where it prices. I think it's in the low 5s, and you're probably believing that you can do one or two small value add things on turnover to build that yield up to 6.25. And you're hoping that this market continues to stay hard to build in and attractive. And that's what you're really pegging your exit to. So I think that two things can be true at the same time, that it can not be a deal for me and also be a good deal for that type of buyer.
I'm with you. I like the idea of this kind of thing. It seems like it works. It seems like it's got maybe a bit of scarcity to it. It's built. You've got some inflationary costs that would create a moat around recreating something like this. It's got enough scale that somebody else can manage it. I like the idea of it, but wow, hard to get excited about those kind of returns.
Yep. That is, I think, how this space trades these days.
Yeah, I think when folks I would be a buyer of this, but I don't have money that would be cheaper than the institutions who will be the buyer here. And I think this would be kind of something where you just say, we're buying this, the real estate's good, and this will be kind of one of our first learning lessons.
At $1 million, they're showing $1 million in NOI on the T12-ish. And if you believe those expenses, that we don't need to get into that. But if it is $1 million and you pay a 5.25 cap, you're paying $19 million. Which is $317,000 a unit.
That feels unbelievably good.
If you could break these up and sell them as condos, you think you're getting out at $450 a unit, which is half.
Yeah,
what single family homes are trading for.
Yeah, I think that's the arbitrage play. Which again, not to oversimplify it, but that's kind of your optionality around exit dynamic.
All right. Well, I think none of us are buyers, and all three of us understand why someone would buy it. Is that probably fair?
I think that's very fair.
Eric, you agree with that?
Yep.
Down. Okay.
No bell today.
All right, boys.
All right, fellas. Enjoy it.
Thank you.